Hi, this is Zach Meir looking at the US blue chips here at Zach's Traders Cafe for Saturday, the 3rd of May. Starting off with the S&P though, as we see that this market has pushed through its 50-day moving average, 55.82 with the next big level there, the old support there from January, and the new resistance there from back in March, so basically 57.80 level to beat. That should be hit even if we fail after that, given that the RSI is only 59, just above the neutral 50 zone. The big prize clearly after 57.80 heading is that we head back to the all-time highs around 61.40. If you're a bull of the market and think that the April rug pull was precisely that, a prelude to a fresh leg to the upside, then 6,500 at that resistance line projection from June last year would be your big summer 2025 target. On the downside, obviously support there at the 50-day line, 55.80, but the risk of, if things go terribly wrong, another move down to the 52.20 area, but not expecting anything worse than that, given that we have ostensibly an inverted head and shoulders there on the daily chart since the beginning of March. Moving on to the Nasdaq, which has been, I suppose, that much more weak than the S&P of late, but actually, if you look at it now, the gap through the 50-day line there, 19,489, equivalent to the S&P, and it means that we're approaching that late March resistance, 20,300. Still need to get back up to 20,600, the old January floor, and that really would be the sign that this market is back in business. You've got a resistance line there from back in February, which is the top of the falling trend channel we've been in since the turn of the year. I suppose obviously there was an overshoot there, but at least while we're above that 50-day line, looking for the 20,500 area, even if we fail after that. Onto the stocks, and it's quite clear the winners and losers in the potential tariff situation. One of the weaker contenders at the moment is Apple, which has already failed at its 50-day moving average, $215. Also failed at that resistance line there from the end of February. So that's the line in the sand. Below that, we are effectively a sell into strength, as underlined by the Friday gap down, and the RSI falling below neutral 50 at 48. Above that, we've got the chance of filling the gap at least up to $220 or a little bit more than that. Yeah, but that at the moment looks like the best we have on offer. In terms of the downside, a retest of the gap area, 194, or the recent swing low, 190, is the risk, even if we then recover after that. Moving on to Amazon, which is not in quite such a fraught state, but not much better either. Fading at the 50-day line there at $192, also at the top of that falling trend channel there from December. Want to see an end of day close above that to give us the chance of moving back up to $205, that March resistance area, and looking for that hopefully to happen by the end of this month. What is positive here, though, is that the RSI is above neutral 50 at just under 53. So at least while we're above the latest gap up $184, the $205 area could still be on tap for Amazon. Moving on to Berkshire Hathaway, where I suppose you can guess that Mr. Buffett sold most of his holdings back in March before the market fell and then bought in again. You can see that we're near the highs, and maybe this is a prediction of what will happen with the rest of the market. But in the meantime, we've got the top of the channel there towards 880,000, and at least while we're above recent support around 785,000, that could be the destination for this market, maybe even as soon as the end of this month. What's also helpful here is that there's been an RSI rebound above neutral 50. We're at 60 at the moment, and that, along with the sharply rising 50-day line and two of the latest gaps, gives this stock a very decent look. Be difficult to beat that for Broadcom, but here you can see at least we're above the 50-day line, $184. We've broken that resistance line there from January, which is around the 196 level. That leaves us looking for at least a retest of the $220 area resistance on the way down back in the end of February, and hopefully that will complete the inverted head and shoulders that we've had in place quite markedly since the end of February. Moving on to Eli Lilly, and here the picture Rather messy, very, very volatile indeed. I think the latest gap down on Thursday and Friday must have caught people out rather painfully, given that it was a bull trap reversal, it's a bull trap gap reversal, and below the 50-day line, $832, there's the risk of at least testing the sub $800 area on the low of Thursday. RSI not too bad actually, near the neutral 50 level. So if you are a fan of the shares, just an end of day close back above that 50-day line could show that we are back on track. But very painful volatility there indeed. Next up is JP Morgan, where I suppose you're guessing, or we are guessing, that won't be so badly affected by tariffs as maybe other stocks are. But here, approaching that neckline resistance of the inverted head and shoulders, so around $255 above that. And basically, we're looking for the shares to retest the best levels of the year towards $280, even though there's a bit of resistance ahead of that. Looks as though with the unfilled gaps to the upside on the right-hand side of that inverted head and shoulders, we are in reasonably strong mood. A stock which one would guess would not be affected by tariffs at all would be Netflix, and here you can see doing that much better even than Berkshire Hathaway, or Berkshire Hathaway as they say in America. Here we've got a rising trend channel there from back in November, top of the channel there heading for $1,300, and we're looking for that perhaps as soon as the end of this month. Very, very strong candles there, all green on the over the last couple of weeks, and a bull flag which is so strong that you actually have the closes higher within that bull flag. So at least while we're above $1,130, looking to hit $1,300 relatively quickly, even though the RSI now at 76 is rather overcooked. Back down to earth with Nvidia next, and here the picture is of a market getting through the 50-day line there at $112, but looking a little bit sheepish about it. The positive, though, is the way that the RSI has bounced at neutral 50. That tends to be a leading indicator on the upside. So given that we're above the 50-day line and above RSI 50, giving the shares the benefit of the doubt that they could at least head back up to $122 March resistance on the way down, even if they fail again after that. On to the last two. The first one is Oracle, and here you can see that similar to the other stocks we looked at, pushing sheepishly through the 50-day line at $145, top of the falling trend channel there, 166, and we're looking for that by the end of this month, especially while we remain above the gap floor there, around the $140 mark. The big question at the moment is whether Tesla can complete any more of a recovery than it has done already. The $300 area a bit sticky for it. There's an old price channel floor line around $304. That is the level to beat if you want to see a full-blooded recovery. But probably if you ask most people, even what the shares have done now is much more of a recovery than was perhaps anticipated. Above that 50-day line at $263, then maybe the low 300s could be achieved, even if the shares fall again after that. That's it for me now. Join me again soon for more updates.